We are at the headquarters of the World Gold Council here in New York City, and I'm joined now by Juan Carlos Artigas. He's the Director of Investment Research for the firm. Thank you so much for being with us.
Oh, well, thank you so much for inviting me, Daniela.
I know you've had a lot of reports, a lot of data coming out, and I thought, what a better way to end the year and begin the new one, so you could really give us a good perspective of where gold is right now. Your latest findings indicate that global gold demand has taken a significant hit, though, seeing its weakest quarter in 8 years. Let's talk about that.
Yeah, we need to first put things into perspective. Gold Demand Trends, one of our flagship publications, compares year-on-year trends. Q3 2016 was particularly strong, especially coming from ETF inflows on the back of Brexit and other developments around that time. So when you compare those in a relative term, it looks weak. We continue to see investment. Now, let's understand that demand over that period fell about like 12% year on year. Supply also actually contracted about 2%. And net, the price performance between 2016 and 2017 on the third quarter is consistent. But let's move to this year. Actually, this year, starting from the end of December to now, the gold price has increased by about 12%. So we need to put Q3 demand numbers in context of what they are comparing relative to what we are seeing this year.
But some analysts I speak to say they haven't seen this price compressed this much. They can't remember the last time they remember that gold has traded like this. What do you think it's going to take for it to break out of this range here?
Again, if you look back, the gold price year to date has increased by 12%. By all measures, that is a strong performance. Long-term returns for gold are going back to 1971. On average, every year is about 10%. So this is above average performance. We have increased to a certain degree. There are a lot of trends, but there are many other things that can happen. I think that is good for the price of gold to increase at this pace, in part because it allows consumer demand to catch up, for consumers to get used to slightly higher prices. You don't always want the price of gold to increase really, really rapidly, because that, while that may benefit investors, sometimes the organic demand coming from consumers is not able to catch up. And that's when you get more corrections. So I think it is a steady and good performance for the price of gold.
So as we're about to start a new year, what trends are you forecasting for gold?
What we're focusing on the demand side, for example, this year in particular, India has been, has had a somewhat weak demand, slightly better than what we saw last year, but it is still not very strong. Now, what does that tell us? Well, it tells us that there was a lot of anticipation and a lot of adjustment based on some of the initial reforms that the government has put out, including the General Service Tax, or GST. However, while we published and discussed that may have a short-term negative impact in demand for gold back a few months ago, we also expect that in the long run to be positive, because generally speaking, over the long run, the most important driver of gold is income, wealth, or expansion, economic expansion. And we do think that many of the reforms in India will create an economic expansion for the economy, and therefore have a net positive benefit for gold.
So is this the hub that you're banking on for gold? Is India the main focus?
That's one of them. For gold, one of the good things about its performance and its function in a portfolio is that it's not just about one market. It's not just about the US, it's not just about India, it's not about investment, right, or just technology. It's a combination of everything. So India is one of them. We continue to see robust growth in China, so that's a positive. We have also seen, for example, Germany start to come out as one of the important markets for gold, which before the 2008 crisis.
And I thought that was really interesting because, I saw lackluster numbers out of North America, but Europe really showing a strong affinity to the metal. So looking at Germany as an example, what was the shift here? Why do you think that gold is more appealing now?
We saw a structural change following the 2008-2009 financial crisis in Europe in general. Before, a lot of people were putting a lot of money into euro-based stocks and euro-based bonds. However, the euro came into pressure on the European sovereign debt crisis, and that made investors in Europe, across Europe, rethink how they protect and manage their wealth. Germany, again, as an example, started to increase their demand continuously. And based on market research that we conducted last year, one of the things we found out is that for German investors, they see gold as a long-term investment, as a way to protect wealth over the long run. And they see it, not just as an asset that they may come in and come out of, but something that is an important part of their portfolio. And that shift really started to happen after the financial crisis. So that's one thing. In addition to that, I feel that for European investors, many of the trends that we're seeing in terms of Brexit or other things may feel more systematic to them, meaning their impact, their economic impact is larger for European investors than it would be for US investors, right? So Europeans pay more attention to that.
That makes sense.
And finally, there was a change in tax legislation in Germany that by which long-term holdings of certain gold-backed ETFs were basically taxed in the same way that physical bars and coins. And that also created a strong, it created more demand for certain gold-backed ETFs and for gold-backed ETFs in general in Germany in 2016 and 2017. The combination of those three trends has created a lot of support in Germany. And again, this is just an example of the broader European strength of the market.